My name's Ashley Garner, and I am uh, with ABG and Associates. And the purpose of today's webinar is to talk about how real estate professionals can save money on taxes by investing in real estate. And, you know, I would guess that most of the people um, on this are real estate professionals, or in some way, if they're not a real estate professional, just like me in my role, then, an active investor, an active contractor, developer, things like that. So we're going to talk about how you can benefit by your investments in real estate. So we'll just get started with an important disclaimer. And we definitely are not CPAs or attorneys or tax advisors. Today, as a matter of fact, I paid a whole lot of money to my tax advisors slash CPAs for keeping me on track with taxes in the IRS. So whatever you hear here is just something that we've learned through experience and through our own education, but this is not tax, legal, or financial advice to you from any of us that will be presenting on the meeting today. You really have to be careful with this kind of stuff, and you really have to talk to your own professional about how it affects your specific situation, because everything is totally different. So that disclaimer is important. Hopefully this will spur some thoughts so that you can go ask your own tax professional and save some money. So a little bit about me, and then we'll introduce Michael. So Ashley Garner is my name. I've been in real estate my whole life. Started literally as a kid, a junior high kid. When my dad started buying multifamily, well, really they were old houses near the campus of West Virginia University. Then we would internally subdivide them and use them as student rentals. So I started with the hammer and nails and went all the way through the management, leasing, acquisitions, financing, all those things. And then eventually got out into the adult world and started doing it on my own account. Started maybe like some of y'all with single family rentals, and then moved to duplexes, triplexes, and then a 10 unit. And then on up from there to our most recent acquisition which is a 196 unit property that we purchased in February. So that's a real quick brief about me, and my partner Michael Crocifolia is on here, and I'll let him tell about himself.
Hey everybody, it's nice to meet you virtually. So I've been in real estate for about 6 years, since 2019, and I would say I'm a classic, what's referred to as an accidental landlord in the industry. So the first property I ever got involved with was actually more so intended to be a restaurant. So my family was involved in restaurants in Pennsylvania, and we made a particular product that we wanted to expand upon and sell to other restaurants in the area. And so we bought a property to scale up that business. And then 2020, what happened? COVID shut down the entire restaurant sector. So what we bought to be a restaurant expansion, we quickly had to pivot. And luckily, that property had an unfinished warehouse, an unfinished one-bedroom apartment, 3 trailers in the back. And what we were able to do was successfully pivot away from running a restaurant to running our first rental property. And we never looked back from there. So I scaled up to about 35 units before I met Ashley about 2 years ago. And we started to scale ABG multifamily since then.
Well, good deal. I'm glad that Michael and I bumped into each other. It's been a good match since we've been together. We complement each other in several ways, and so it's been good. We've got a guest speaker on here too, Bill Smith. Bill, would you like to introduce yourself?
Yeah, my name is Bill Smith, and you can see it's spelled just like it sounds. And I've been doing cost segregation, which we're talking about here, for about 13 years now. And I've been in the real estate, more lending and finance space pretty much my whole career. And so I've been in and around this. My father was an architect developer, so a lot of family in real estate. So I've been in and around real estate investment and services pretty much my whole life. But for the past 13 years, I've been really focused on cost seg and the benefits to commercial investors.
Yeah. And just so everybody knows the relationship, I met Bill because I've used him and his firm on cost segregation studies for properties that I already own, and I've already benefited from a lot of the stuff that we're going to talk about. And so when we decided we wanted to share this with everybody, he said, well, why don't we just bring Bill on and have the expert talk about the cost segregation study? So that's why he's here, and he's a great resource. All right, so let's get started. Why does this matter? Well, as you guys know, the taxes are one of the biggest drains on wealth. We as real estate professionals have a unique advantage that most people don't, and real estate offers unique advantages that most other investments don't offer either. The key here with this is that if you take the depreciation and you combine it with your professional status, your real estate professional status, that's when the real magic happens as far as the benefits on saving taxes. All right, so the magic of depreciation. So things that are everything, not everything, most things that are improvements to real estate can be depreciated. And like the land, you can't depreciate land. Land is, it is what it is. It never loses its value, and it never goes away, right? But when you go and you start building things on the land, buildings, apartments, offices, whatever it is, then those buildings and those components that you add to the land called improvements, they do not last forever. And when you build them, they immediately start deteriorating or depreciating in value. And that's what the IRS allows you to take that paper loss on, which is that second bullet point. And so, for example, you put a roof on a house and it has a useful life of 25 years or whatever. So the first year you use it, well, it only has 24 years left. So it has, you have spent money, on that. It's gone down in value. And so that's the key thing. That's that depreciation that the IRS allows you. What the depreciation does is it can reduce your taxable income. And when your taxable income goes down, that means you pay less in taxes. And when you pay less in taxes, that means that the cash flow goes up. And when that happens, that means you have more money in your pocket. And the idea is that you use that money, the more money that you have in your pocket, to invest in more real estate. All right, so quick example is you collect rent, but you report a loss from depreciation. So just because you show a taxable loss, that doesn't mean you didn't get to collect cash and put it in your pocket. And that really is the magic. That's the whole magic of it, that you can actually collect cash money, put it in your pocket, but you can put on paper a loss and thus reduce your taxable income. And Michael and Bill, feel free to jump in here. I don't want to monopolize anything. I may know least of anyone on this call, so jump right in anytime.
I think one of the things when you talk about the taxable loss, and that's great, but even the IRS calls this a cash flow strategy, because by paying less taxes and deferring this tax on what's normally an appreciating asset, you're allowed to depreciate, as you pointed out, it appreciates. You then, by having that cash flow, you can buy more properties, reinvest in your current property if it needs to be upgraded, right? Maybe you're doing a value add property. So that taxes really helps you. So even the IRS calls it a cash flow strategy, so that's one of the things that really is important. As much as it is like, hey, we'll take these losses, it's about cash flow, because you're not paying the IRS if you've got estimateds, which you have as a real estate professional and have a real estate business. Some people might have a real estate professional spouse, and so they're going to get a big refund. But that's one of the key things is cash, right? Cash is king.
Cash is definitely king. Anybody who's been in a business that has a profit, makes a profit, but doesn't have cash, you know what that's like. All right, so two buckets. You got the buckets of income, right? That the IRS says you got ordinary income and you got passive income. And normally those buckets don't mix. Okay. And so there's a little bit of the magic. This is where that real estate professional status comes in. And so think about it like if you're whatever, you're an architect or a doctor or a teacher or whatever it is, and you get paid for that job. That income goes into your ordinary income bucket. Okay. Now, if you were that person, that teacher or whatever it is, and then you bought a rental property and you received income from that rental property, well, that would be an example of a passive income. And normally the income that's in those two buckets does not mix. Okay. Now, if you have income, you can have losses, right? And so you've got ordinary loss or a passive loss. And again, those things don't mix. So in other words, you could not, or the IRS does not want you to use a passive loss to offset ordinary income, and vice versa. And so that's kind of that's what leads up to this special magic of being a real estate professional as designated by the IRS. Bill, you want to talk about who can and who can't, or what the IRS likes to call real estate professionals?
Yeah, so there's what's called reps qualification or real estate professional status, rep status. And what that means is it doesn't mean you're a realtor. It doesn't mean you are necessarily anything specific as a real estate professional. It means you're an active participant in the duties and in what's called the real property trader business. So unfortunately, well, if you're a lender or you're a handyman, landscaper, electrician, oh, I'm working on homes, I've been working on real estate all day long. That doesn't make you a real estate professional. I mean, there's certain criteria associated with qualifying for this. And this is a trigger for an audit. If you claim reps and you got a W-2 40-hour-a-week or salary job, you're likely going to get an audit because you don't do that unless you have a spouse that does it, or unless you have a real estate business like Ashley, and that's all you do. So for this one, the next slide kind of talks about some more of the qualification, because a lot of people think, oh, if I'm doing this, I'm automatically a real estate professional. No, you're not. So the next slide will kind of go into kind of the qualification. Like, the IRS identifies 11 specific types of real property trades or businesses. So those are activities as an active participant. So you don't have to have a real estate license or anything. You could be a stay-at-home mom or dad, and you could be working on development, redevelopment, construction, reconstruction, acquisition, conversion, rental, all these activities that would define the criteria. Now, if you are not in a real estate business and have an LLC and it's what you do all day long, and then you don't have to track to be a reps, if you are and this is one of the other beautiful benefits of this that Ashley talked about, is you've got a high earning doctor, lawyer, consultant making $1 million plus a year in income, and then the spouse says, I'm going to start investing in real estate, it's multifamily, and taking that depreciation to offset those high tax liabilities that high income earner makes. And so that's a lot of my clients fall into that category. So in that scenario, you have to track your hours. You have to spend at least 750 hours per year on real estate, and it's got to be at least 51% of your professional or working hours. You can have another part-time job and things like that. And I think here's the criteria that talks about that right now. But you don't have to be in the real estate, for the file return as such, but you need to track your time. You've got the material to participate in those activities I mentioned on the previous one, and at 750 hours a year, you got to track it. It's a simple spreadsheet. You just need to track it. If you get audited, which is very unlikely, but the IRS will look at that. And again, it's like 51% of your working vocation hours. If you have a full-time W-2 and you claim rep status, that'd be a trigger for an audit if you were filing, not jointly with a spouse. So
Yeah, so
that's definitely a trigger.
So Bill, if you're like me and the only income I make in my whole life is from real estate one way or another, then I don't have to track my time, right? But if
You don't
I
have
did
to track that at all.
Yeah, if I did a different job or profession or stay-at-home mom or whatever, then if I track these criteria under the otherwise set bullet point, um, then I could be counted as a real estate professional, right?
That's right. And you're both doing the same activities, but if your business is real estate, and you could be a realtor, and then part of those realtor hours can qualify you, and you might be investing in property and you're selling people properties. Part of those hours can qualify for your 750. So there's strict rules behind that. I just wanted to kind of point out that besides being, okay, I'm a real estate tycoon, that's all I'm going to do. You don't have to track it. You got a business that does that. Your ABG, that's what it does. But if you're not that, and I want people to understand that, because there are a lot of situations out there for high earners where you can say, hey, the spouse can do this, just need to track it because they're working a little bit or doing something, help out at the school some days or, coaching something, you just need to track that because in the event you're audited, IRS will look at that. But so many of my clients will fall into that bucket, or certainly a lot of them are just real estate investors and they don't really have to track it at all because that's what they do.
And back to that disclaimer, we're not here to tell you that you've qualified, and we're not you shouldn't take what's on these slides and say, you know what, Michael told me that I am now a real estate professional, so I'm going to file my taxes that way. What you should do though is you should do your own research, and you should ask your tax professional if they haven't brought this up to you. Then you should ask them. Say, hey, I learned that you can do this. I would like to take advantage of it, and have them educate you on that.
Random question on that. What is the benefit of reps being qualified, for reps? Is
Yeah, well,
what is the tax savings, I guess?
So Lee, it's the crossing over of the income buckets. So if you're a say you're a realtor as an example, and you own an investment property. So you sell somebody a house, you earn a commission on that. Typically, you would have to pay tax based on your income bracket, whatever that is. Um, if you have that rep status, you can take a passive loss on the investment that you have and use it to offset the commission you earned on selling a house. So it's a unique crossover of the passive and active income buckets that reps allows you to gain access to that most people in society don't have access to.
Got you. I'm up with you.
yeah. And so, like Lee, for me, and again, I can only tell you about my own situation, but for me, like all of my income goes into one bucket. And so if I have a loss, passive loss, or excuse me, a loss from one of the investment properties, then it can offset the income or reduce the taxable income, even if the income for me is the commission on selling a house. But normally they would separate that, like your salary from your day job would be over here in ordinary, and your income from your rental house would be in passive. And so what we're trying to do is we're trying to be able to mix those things so that we can use the loss from the depreciation to offset our taxable income as a whole. That's the whole idea.
Yeah, I think the biggest thing is just taking that passive loss against ordinary income. That's what cost segregation and things will allow you to do, and what reps really allows you to do. There's reps qualification, so you can then offset any ordinary income. So the real world example is you buy $1 million property. We do a cost seg study on it. We'll say the basis is $1 million. You would have paid more because you have to take the land out, as Ashley mentioned. So it's $1,250,000. So now you got $1 million. We identify 30% of that property to short life to reclassify those assets and through a cost segregation. So there's a $300,000, of depreciation in terms of you can take as a loss this year. Now, if you make $300,000 in a day job, or you've got that can offset that ordinary income, not stock sales and other kind of business, but just ordinary income. That passive loss is unlocked from passive into being able to offset ordinary income. So then that's why real estate professionals and real estate don't pay taxes, because they use this big depreciation, taking this loss up front to offset. Meanwhile, in that property, as Ashley said, you're going to show, you might have on a $1 million property $100,000 in income, net income, but with that $300,000, you will show a $200,000 paper loss but you put in your pocket $100,000 of cash. So you still have positive cash flow, but then you don't pay any taxes and you show a loss. And that 200,000 will carry forward to the next year and the next year until you use it up, or you buy more property and do more depreciation.
Yeah.
Hope that
For
helps.
sure. For sure. No, it's huge. It's like mind-boggling, really, that they even allow us to do it. The depreciation, the whole thing, and all of this is totally legal. You just have to make sure you follow the rules for your own specific situation. So if you are one of these things, that are on the screen right now, there's a decent chance that you could be qualified as a real estate professional, and you should ask your tax preparer to tell you all about it. And hopefully you can benefit from it. One real life example, as you might expect, since I'm in the real estate business, I know a lot of real estate people. A lot of the people that have invested in the deals that we have promoted are also real estate professionals because they're in the same industry. And I remember the first time this one particular person prepared their taxes, it was the first year after they invested in one of the projects. And so we gave them the K1, they got the K1, they prepared their taxes. And, I saw them in the parking lot, and, they literally almost came over and gave me a big hug because it made such an impact, the reduction in their taxable income. And it saved them so much in cash money, months after they had made an investment in one of our multifamily deals. So it's pretty powerful. So Bill can talk about this too. This is a pretty cool slide. One of the things that you have to do if you're going to really take full advantage of this depreciation thing is that you have to get a cost segregation study. And the cost segregation study is performed by a firm like Bill's, and they send an engineer out and they count up a bunch of stuff. So that's what this slide illustrates.
Yeah, a lot of people say, okay, well, what does this mean? And so normally if you buy a property, there's the straight line depreciation. If it's commercial property, it's 39 years. If it's residential, it's 27.5 years. If it's a short-term rental, an Airbnb, with average stay less than 30 days, it's still 39 years, or it's going to be 39 years as a commercial property, even though it's a single family home. So there are some nuances to that because you collect transient tax on that like a hotel. So an Airbnb, for anybody, that's considered a commercial property, 39 years. But anyway, straight line method means you just divide it by 39 or 27. So $390,000 house, you divide by 39, and that's 10,000, per year for depreciation. So it just looks at the whole thing. The structure building doesn't look at the parts. Now, with cost segregation, the IRS, you're allowed to take those parts, as Ashley pointed out, and then identify those pieces that can be reclassified into a shorter life. 5 years, 7 years, 15 years is typical. There's a few other life classes, but those are the most prominent. And so cost segregation, when you look at straight line using the Big Mac, everybody knows the song, all the parts, but straight line, you look at the little little magnifying glass, it's just a plain hammer. You don't see anything special. It's just no parts. Where in cost segregation, you break down the 2 all beef patties, special sauce, lettuce, cheese, pickles, and onions on a sesame seed bun. And each one of those might have a different life class. And so that life class gives you deductions, which you take today. $1 today is worth more than $1 tomorrow. And so you take those deductions today, that creates those losses, which then reduces your taxable income.
Yep. And so the idea is that by doing the cost segregation study, you can you can depreciate a larger dollar value sooner than you could if you didn't. And so that's why you would want to spend the money to have the study done. And then you have the study in your file to defend the numbers that your tax preparer puts on your tax return in case the IRS comes calling and you say, well, hey, I had ELV do a study and here's my study. And then the IRS is like, okay, I got you. And that's, you're in good shape then.
Actually, what would happen is you'd say, hey, the IRS called me ELB and here's their questions. And then we address it. We defend you as long as you own your property for no additional charge. So.
Okay, good. Well, I hope that never happens.
But sometimes you just show them the study. They go, oh, okay, you got the study. We're fine.
Right. I hope that never happens.
It's very, very
right
rare.
now.
but we've done plenty in, not that many really in 23 years. So
Well, that's good. And Bill's firm is they're in the process of doing the cost segregation study on that 196 unit property that we bought. So like 2 weeks ago, their engineer was out on site, and I don't know how it works. I wasn't there, but I'm envisioning them going through on this laptop or this huge form and saying, all right, there's 2,000 light switches and there's 200 ceiling fans and however many square feet of roofing shingles and all this many square yard or cubic yards of asphalt. And then they go back and they go back in their office and work on this report and calculate up what all of each of those things are worth and what life category they fit into. And then they give us back this big number that we can use for depreciation.
that's pretty much it.
Pretty much it. All right. Well, that's good. And it's a big number. So let's see, we've got this example case. I kind of went through this a little bit already because let's see if I can go back, because I told you about that person that coming across the parking lot to give me a hug. You're earning income, you've got your cash flow from your investment, and then you get your losses from your depreciation, and that loss offsets your income, and it's a significant reduction on your tax return. And by the way, I think it's important to understand why would the government allow you to do this? They're not doing it just to be nice. They're not doing it just because they like you and they want you to have more money. They're doing it because they want to try to manipulate you into doing something that they want you to do. Now that may be my own opinion, but I think that's probably true. And that, bottom line is there needs to be more housing because more people need more places to live, right? So they need people like us on the call to provide this housing. The only other alternative is that the government has to step in and provide the housing themselves. And that's not a good situation. The government is not a good landlord. They're not a good developer. They're not a good builder. And so they say, okay, well then I'm going to give Ashley and Michael and whoever else, I'm going to give them a break so that they've got more cash in their pocket that they can then go out and build more housing and provide more housing and be better landlords. That's the whole reason that this is done. So it's not a loophole. It's by design. It's like we want these people to go do this, and we are going to incentivize them to do it through this method.
Yeah, and it works on smaller projects as well. So we're going to walk through an example it's pretty big. It's 196 units, but Bill's helping me out on a duplex as well. So it's a short-term rental in the Wilmington, North Carolina market. We're going to do a cost segregation study there too. I've done one on a 6-unit. I've done one on a 9-unit. So it works across the scale that you want it to. It doesn't have to be a huge project to execute this.
Yep, that's right. Yeah, that's a great point, Michael. Just kind of off topic, but that's really the only difference in scaling your real estate investment portfolio as a whole. It's the same business whether you're buying a single family rental or you're buying a 300 unit apartment complex. It's all exactly the same. It's just times a larger number, and it works exactly that same way here. Obviously, larger assets. There's more depreciation because the value of the improvements is higher. But it works on any size. Bill, is there a limit? Do you have, in your opinion or from your experience, like the value of an asset where it's worth doing a cost set or not?
So it kind of depends on the asset, different asset classes, multifamily versus industrial versus flex versus car washes versus, hotels. They all have a different kind of ranges of benefit. And it's the specialty components that make a difference. You need kind of the function. You need 4 walls, roof, windows, doors, HVAC, bathrooms. Fundamentally, that's what you need. Everything else, single light per room, everything else can be accelerated. Specialty electrical, specialty plumbing, kitchens, not baths are required. parking lots, landscaping, all those things can happen. And so, I've done just this year, probably, and just in this calendar year, we've done a bunch of stuff. I've done $100 million, Caesars Resort Hotel in North Scottsdale for a client, done a lot of hotels for them. But that was a pretty big one. We got 24 million worth of benefit for them. It's right, if you know Scottsdale and Goldwater Road, right by that fancy mall in downtown Scottsdale. Then I've done $150,000, $200,000 homes. We have a single family. We have a tool for doing smaller homes. So a small home can also make a difference as well. So the range is pretty large. You've got to, probably 200,000 kind of is where I've seen them go a little lower though, because the tax benefits can be, still substantial, but proportionate to that particular house. If you're making money on that, then you want to offset. Or if you want to, use it for, again, your real estate professional of multiple homes, then you can use those. We have a software tool that we use for doing smaller properties. So I mean the range is pretty wide.
Pretty wide. Okay, good. And again, it's the same math, it's the same rule, whether it's a single family rental or if it's hundreds of millions of dollars. Same rule.
Yeah. It's just classifying the different asset components in there. So
right. All right. So this little chart on the screen is a screenshot from the estimates on the proposal that Bill and his firm gave to us when we set out to do the cost segregation study on Bryn Mawr Village. And Bryn Mawr Village is the asset in Jacksonville, North Carolina that we bought in February. It's 196 unit multifamily. So we had them give us this estimate, and they subsequently are in the middle of preparing the report. But Bill, instead of me stumbling through this, how about say it? I can say it, but I sometimes get hung up
it's
on
a quick recap. We put in our proposal. We kind of have a more detailed analysis page. But what this is telling you, so in year one, first of all, this year, 100% bonus is back. It was in part of the One Big Beautiful Bill. And so what does 100% bonus mean? Everybody goes, oh, I get extra depreciation. Yeah, this is great. No, you just get the same amount of depreciation. We're still going to reclassify the same assets, as a percentage of your basis. And so in this case, we probably have a range of 22% to 42% of the basis, probably typically multifamily looking when we go conservative and optimistic. Okay, what's the lowest we've seen in this asset class? What's the highest? Because methods and materials of construction make a big difference. How many features there are? Are there ceiling fans? Are there window treatments? What kind of flooring is in there? What is HVAC? What's the roof? What kind of landscaping is there? I mean, a very rudimentary property is not going to have as much depreciation benefit because it's just got the fundamental needs versus a more ornate beachfront Airbnb that's designed for families to come down there and have 30 people in the house, and you've got all kinds of features and pools and things like that. So what this does, so that's how you get a range. And so here we've got a range of anywhere from 3 million to 5 million on this particular property. Usually we fall somewhere in the middle. Occasionally we exceed the top, but again, methods and materials of construction and property features make a difference. A lot of people send me their OMs and say, hey, well, how's this property look? You guys send me a whole bunch of stuff in California, different shopping centers. Which one? How is it? I'm like, it's hard for me to kind of commit to it, but I can kind of point out, here's the things that make a difference for depreciation. So what this means in the tax benefit range under the orange, 2.9 to 5 million, that's your deduction. That's your accelerated property. So we're going to identify certain percentages of 5, 7, and 15, but 100% bonus means you can take all that in year one. So these investors are going to get a huge K1 loss year one. Now, what does that mean? At a 37% tax bracket, which we assume, the whole cash flow example is you multiply 2.923 million by 0.37, you get $1,081,000 in cash flow. That's what you're not paying the IRS. That's the tax savings. So any tax deduction, whatever your tax bracket is, if it was 25% or 37%, your tax bracket is a percentage of that deduction. So here you're saving either $1 million or $1,008,000 based on the results of the cost seg study. And then it goes over 5 years, but over 5 years, years 2 through 4, you're just doing straight line. So you still get benefits, but the real benefit with 100% bonus is year 1. And once you do that, then you're hooked, and you're coming back every year. And I've got people that come back every year, and I'm almost like a dealer. I'm just dealing depreciation. They're coming back and they need more depreciation because they got more income and they want to offset.
And so that keeps people buying new projects so that each year they can have, that big bonus depreciation hitting, saving on their taxes. And it's a huge thing. And so to make sure I understand, Bill, let's just assume that I own this thing all by myself. I don't. We have like 30 partners, 30 limited partners in this. But if I owned it all by myself and say, it's $3 million is the conservative estimate, then that means I'm reducing my taxable income by that much, right?
That's right. I mean, you have a deduction of $3 million.
Right. Which translates into roughly, a little bit over $1 million less in tax that I'm paying the IRS in that year. Right.
That's correct. And so what happens? Well, let's say your income, you get $3 million. Man, I got this. But you have only $1 million of income to offset. Well, then that $2 million that's left over, you're going to show a $2 million loss. You'll pay 0 taxes on that $1 million. And then you've got your next 2 years that carries forward. So any unused depreciation, or like people that have a K1, right? Some people may not be real estate professionals. That's going to cover any income they have or any other passive losses when they get a K1 for you with a loss. So one other thing to point out, if your adjusted gross income is $100,000 or less, then you can use depreciation against ordinary income. Like if you just have $100,000 salary, some people, have, and they're investing in, they might invest in this, and they might get a $24,000 loss on their K1. Well, you know what? Because they put $100,000 in the investment, then they're going to see, or 50,000 probably would give you that on this one. They can take that against ordinary income from 100 to 150. Then it scales that 25,000 to 0, and then over 150. That's when real estate professional status is. So depreciation can help, lower earners. But if you're on a joint return, it's got to be on a joint return. So there are all these nuances. And then, as Michael mentioned, the short-term rental, there's a kind of a reps status light for just doing short-term rentals, which I do a ton of those across the country. For people that are doing it, you don't have to have quite the hours. You can have a W-2. I did it for myself. And so the short-term rental is another, that's called the loophole, where cost segregation is not. But because it's like a nuance in the tax code where you can use your short-term rental. It's like reps light, just 100 hours versus 750. And the same applies. Take that depreciation against ordinary income. Short-term rental homes usually have a lot of features because you got to make it attractive for people to come want to rent there and hang out. So they tend to have a pretty good percentage. So those are very popular these days
and you don't lose it. So it carries forward. If you can't use it all in the tax year,
correct.
And you can keep that reduction, that loss, and use it towards more. So if you don't have other passive income that you can use it against, but you can only use it against the passive income that this particular asset makes you, well, theoretically, you could just pay no taxes on that income for quite a long time, maybe 5 years, who knows? Just depends on all the numbers. But the point is, you don't lose it if you can't use it right away.
Never lose it. Yeah, any depreciation will carry forward for up to additional 19 years. It's 20 years total, current tax year plus 19 additional. And then if it unlocks to offset any capital gains, if you have somebody, you sold a different house with capital gains, you say, oh, well, you still use this depreciation from this deal to offset capital gains on a single family college rental in West Virginia you might have had, you decided to get rid of. So
Right. So we made this slide because, and this is an example of the math, and this is assuming a 37% tax bracket, but this is an example of the math on this Bryn Mawr Village. And so the first column here in the chart base case, that's not including any depreciation. That first column is translated over to the charts in the dark blue. Okay. So, cash on cash return, we're expecting 6.5%. That's without factoring in depreciation. And then if you go and say, all right, well, what would happen if I, factor in the benefit of the depreciation before cost recapture? We could talk about recapture and what that means. But look at what happens to that cash on cash return. It goes up, to a like almost unbelievable number, 22% right away. And what about if you go with if you go in with the appreciation, recapture, it reduces that a little bit, but it's still giant. And that's what's important. It makes a huge difference in the overall performance and return of your investment on something. So it's not just how much money did you collect, but it's how much money did you keep in your pocket and in your life. And that's what we're trying to like really paint that picture so people will learn more about it. All right, so key takeaways. You get your cash flow, but you can maybe have no tax liability for certain periods of time if you use this. Your real estate professional status will give you a huge advantage over people with a non-real estate professional status. Multifamily investing, it compounds everything simply because you're multiplying by a larger number than just one. Although it's the same math and the same rules, whether it's one or whether it's 500. And of course, consult with a knowledgeable tax professional always. Don't make any decisions based on what you hear on YouTube or a webinar or anything else, but take that knowledge and go ask somebody who knows the rules. And
don't
go
take
ahead.
TikTok tax advice.
Yeah, right. Yeah, definitely don't do that. I'll show you, let's see if I can make a quick switch. Right now, who's got questions? If you've got any, now's a great time to ask them. And I'm going to pull up another presentation real quick just to show you something, if I can find it. Here's that slide I just showed you on Bryn Mawr Village. This report, by the way, that I'm looking at is our third quarter investor update. So we give quarterly updates to our investors, and this one just happened like 10 days ago or something. And I did a live Zoom call just like this, and we went through these slides and we talked about the property. But one of the things that we highlighted on was this cost seg, and everybody is really anticipating that with excitement on how it's going to affect their life. By the way, Bill, this is a picture of the laundry facility. And, when we
actually,
bought,
I don't know if everyone can see it. I can't see it.
Yeah,
Oh, my bad.
you're still showing the PowerPoint.
Oh, thank you.
And while Ashley pulls that up, I know he just gave the key takeaways on the slides, but I'm going to give you Michael's 2 key takeaways from this. So the first is ask your tax professional if you qualify for rep status. And number 2 is don't wait to invest in real estate. So if you want to offset and impact your taxes, you can do it now. You can do it in 2025. You got 45, I don't know how much time, what do we got? 60 days left till the end of the year. You can still invest in property. You don't have to source the deal yourself. There's qualified GPs that do this on your behalf, like Ashley and myself, where you can benefit from this tomorrow. And so it's not something that you want to wait. You can take action now.
Michael, just to further that thought, it's a great point. So are you telling me, I already know the answer, but I'll set you up. Are you telling me that I could like wait until November or December, right at the end of the year, and invest in something, and I can still take advantage of all this bonus depreciation?
Correct.
Yeah, it's amazing. We bought a property in December 2 years ago, and did the same thing. We did the cost seg and everything. We only owned the property for like less than a month, so we had virtually no income. And then we did the cost seg, applied all of the bonus depreciation the first tax year. So we had huge losses coming forward, and still have them on the books that we're going to use again for this tax year. It's really an exciting thing. It's a great point. All right, let's see. This tests my technical ability here. All right, does everybody see a picture of this burn up laundry room on one of those pictures?
Yep, we got it now.
Yeah, good. All right, so this is a picture of the laundry room at the property that we bought in Jacksonville. And during the contract period, the laundry room caught on fire. And as you can see on this picture on the left, it was a total loss. The structure was good, but we had to redo everything, all the wiring, the lighting, the HVAC, like everything. And then on the picture on the right, it's what it looks like now. And it's all nice and new and shiny and wonderful. But, when you do improvements, Bill, right? You do improvements to properties, you can take those benefit you, right? As on
Absolutely.
your depreciation, right? And I don't know, I maybe shouldn't put you on the spot and ask you this question, but I'm interested. Isn't there some kind of like disposal value? Like if you tear the shingles off a roof and you go throw it in the dump, you actually can get some money for that.
Yeah, that's what's called partial asset disposition, retirement of asset, disposition of asset. So, and a key example is, let's say you had this fire here, a bunch of damage. Well, if we'd already done the cost seg study, we would know what the value of those things were. You could expense those because they were lost. Now, if you get insurance to replace it, you can't, you know, you don't pay for the insurance. I mean, you can expense the losses of that, we have of asset value on the study because we give you an asset value for everything. But once their insurance is replacing it, you can't take, you can't take the insurance and that's not capitalized, right? It's not a capital expense.
Gotcha.
But a key example, what you said is most people will change the roof out and somebody gets on their shingles and they shovels, they throw them in the dumpster and haul them away. Well, we did a cost seg study and the roof had a value of $25,000 left. I mean, it wasn't new. And you go get a new roof for, 80 grand. You just threw $25,000 expense away in the landfill. You want to, take that off and take partial assets, expense that. Expenses are better than depreciation, depreciation, and then put the new roof on for 80. Otherwise, you would have $105,000 worth of roof on your books, and that'd be $25,000 worth of what we call ghost asset. So it's really important. And so the IRS wants you to do that. They actually prefer component level depreciation. In the 2014 final repair regs, or tangible asset regulation, outlines all that to then expense that. So when you do improvements, you can expense what you threw away, and then you can also then, take care of what cost segregation, what you put in, like appliances, 5-year property, flooring, 5-year property, drywall and walls and things, that's straight line property, but the other components are going to be short life.
Okay, good. Well, like I said, when you couldn't see it, this is the report that I gave to the investors about 10 days ago. And as you can see, this goes into a little bit, this is kind of a side, but goes into a little bit about what Michael and I do. And, the industry term for what we do would be called like a general partner or an operator or a syndicator or a promoter. And so we go find these deals and then we put them together and we buy them and we operate them. And, there's a picture of the beautiful pool and some of the townhouse units. And so this allows people to, can you see?
Yep. Go ahead, Ashley.
Okay. Yeah. So this allows people to be an owner of a larger multifamily asset without having to do all the work and without having to come up with all the money. So we have investors in this property ranging from $50,000 up to our largest single investor had invested $700,000. And so all of these people get to benefit from the hard work and experience that Michael and I have and get in the real estate business without actually having to go find it and buy it. And this chart, by the way, just happens to show what we've done to the net operating income since we bought it. That first month, doesn't count much. It was like a partial month, but you can see that we've steadily increased it right up to our budget number. And it's performing very well. This occupancy, by the way, at the time I made the video, the average for Q3 was 95.4. Well, in our property management meeting on Monday, that we were happy to receive the report that our occupancy level is now 97.9%. So now we get to have fun conversations like, can we raise the rents here or there? Can we tweak these incomes and expenses with our whole purpose to get that net operating income up as high as possible.
So
There's a
actually, we
couple
got a quick
questions over
question
there.
in the chat for Bill.
Okay, yeah, what you got?
So Jose said, I have a house that was condemned for lead. I'm a lead certified technician. I am in the process of remediation. Can I still do a cost segregation if remediation is not complete?
You can, but you might as well wait till it's complete. I mean, we would look at what you did. If you did some expenses, if you changed things out, you might have torn things out. If it's just lead paint, then you basically have to, I don't know what you remediate. You scrape the paint, do it, or if it's pipes. So we would look at that and the improvements and the purchase, because there's what's called purchase price allocation. So on this deal that Ash did, we do it on the purchase price. And then if there's improvements, then that's separate. They're always separate. There's a purchase price allocation. We deal with the purchase price. We, identify all the assets. We apply a value to every asset using a national cost database like insurers use through RS Means. Probably won't know what that is. And then we apply life to it. So that will, yes, you can, but it'd probably be good to look. I'd probably want to look more at the deal, but yes. And then on Vikram's, I've done properties in Spain and the Virgin Islands, U.S. Virgin Islands, British Virgin Islands, Mexico, and Puerto Rico. We've done Puerto Rico, Costa Rica. As long as you're a U.S. entity, if you've got a house in the UK and you own it and you pay taxes in the US, and even though it's in the UK, there's a chance we can still do cost seg on those. We do properties that are owned by offices and manufacturing by big companies that have them elsewhere, but they still have a U.S. tax liability. So if it's dealing with, if the income has U.S. tax liability, you can utilize it over there as well. Now, if you're a resident there, and then they don't recognize this, a whole different world. But if you're a U.S. entity and you're paying tax in the U.S. and you're collecting that money and you're bringing it here, then yes, you can do a cost segregation study and use depreciation on assets outside the U.S.
Awesome. Two great questions. Bill, we had to do that too. We had to upgrade a bunch of electric panels too, because they were, in the back of that truck, that's all the insides of these electric panels that we had to swap out because they were old Federal Pacific electric panels and they weren't up to snuff.
Yeah, well, we'll get the old to news and we'll be able to kind of identify, you can do some expensing, and we'll get with your CPA to identify how you can then take those expenses, because those are even better. Those come before the income. So that's going to reduce your taxable income, which just makes the cost seg that much better.
Yeah. Yeah. Well, and so on this property, the last thing I'll say about this investment, I was happy to report to the investors that, hey, on this example, the two things that we've done to improve their performance was we because of a whole lot of things in a whole different webinar we can get into, but our financing in the terms of the structure, we actually needed to raise less money than we set out to raise. So we initially set out to raise $8 million. We ended up only needing to raise $6 million. And so your slice of the pie got bigger if you're an investor, if that makes sense. So if you were a $100,000 investor, you benefited because your piece of the pie got bigger. Additionally, when we bought the property for $21,250,000, it appraised for $21,800,000 at that time. And as a part of the refinance that we're currently involved in, we had to get a new appraisal. And just like a month ago, that appraised value came in at $25,400,000. So 17%, I think it was, is the increase from the value when we bought it to the value current on its current appraisal. And, that's all because of, it has, there are factors that are involved, like interest rates and cap rates, but in large part, it's due to the savings and operational efficiencies that Michael and I put into place to reduce the expenses and increase the income, resulting in a higher net operating income. So it's really, this is like the most fun game that for us, we love it so much that to take a project and say, all right, how can we make it more valuable? At the same time, how can we pay less in taxes? And hopefully everyone's successful, and then we just keep going and do it again. We're having a good time, aren't we, Michael?
We are. And it's just, I think it's important to note that this investment's actually still open. So what you see on the screen, if you wanted to, realistically, in a hypothetical, you could put 100 grand into the Bryn Mawr Village deal that's already outperforming its metrics. It's going to deliver on its average annual return, and you can already get that 57% uplift that we've already achieved without looking in arrears. So you can literally benefit from this by putting in 100K today and having in the on paper 157K tomorrow.
Yeah. And so we've taken a lot of the risk out of it already because we've already been through the contract process. We've bought it. We've done all this work. And I think, what do we need to raise, Michael? One and a half, 1.5
Yep.
million is to get us to our 6 million.
Correct.
And then we're finished. Yeah. So if anybody wants to try your hand in multifamily, this could be a great opportunity for you to do it. And there's our contact info right there. Ashley at ABG Multifamily or Michael at ABG Multifamily. You can go to our website, abgmultifamily.com, and you can find links to all of this stuff. Even a link to the deal room for the Bryn Mawr Village asset, and you can go through and create your profile and set it up online right then and there. And we're just two ordinary people, so there's our cell phones. If you want to call us or text us, we'd love to talk to you that way also.
And I just put in my contact information in the chat box. If anybody needs to have any questions on cost seg, because people always say, well, can you use it? How do you use it? I mean, that's all part of my due diligence to make sure that it's beneficial to you and I do a lot of tax strategy, but I'm not a licensed tax strategist, but I direct people to here's how I know how it works. So
yeah. And y'all, I've used Bill, and Michael and I are in the process of using him again right now on different things. We definitely recommend him and his firm for cost seg studies. And don't try to do this. This is not a do-it-yourself. This cost seg thing is not a do-it-yourself job, in my opinion.
that's right. IRS, if you get audited, they're going to want to know how you did it and what the methodology is and all that detail. And that's what we do.
Yeah. Good.
Since 2002.
Well, anybody else have any questions or comments you'd like to go over? No? All right. Well, if not, we'll go ahead and wrap up this meeting. We'll email you the recording and the assets, and catch us offline if you're interested in talking more about any of this stuff or investing in any deals. Thanks for coming.